Hey, Dan Passarelli here. How are you feeling today? All right, we are completing Greeks month here at Firstrade with, like I said last week, we're just putting everything we learned in week one about Delta, week two about Theta, week three about Vega, and we're putting it in a big pot and mixing it up and making something delicious. Today, we're talking about trading option Greeks, management, adjustment, and exits. Before we get started, I need to point out options are not for everyone. Read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here today is providing generalized information, not specific to your situation. If you need advice specific to your situation, contact a financial advisor. Now, allow me to introduce myself for those of you who don't know me. Do we have some familiar faces? Wait, let's take a look at who's here before. Let's not talk about me. Let's talk about the important people here. Let's talk about you. Oh my goodness, I see some new names here. That's really exciting. Golly. Oh, I see some familiar names here too. But I see new names. And you know what I like about new names? They're new. And I like to welcome you. So if you're new, my name is Dan Passarelli, and I am an author, a serial author. I don't write about cereal, but I have written more than one book. I've written two. I've been part of a couple other ones, and I'm working on my own very own third, but that's not going to be out for a while. But I do talk about it on my podcast, which is Wealth Building with Options. You can check that out on Spotify, Apple Podcasts, and any place that you get your stuff, your podcast. I'm just making a little note here. Okay, so I'm an author. And the main book that I wrote, the most popular one, which has been ranked in the top 5 options books written, which is really pretty darn great honor. I'm there with some pretty amazing company that I'm humbled to be even thought of in the same group. But Trading Option Greeks, it's been called the Bible of the Greeks. And if you want to take everything you learn here today even farther, then check that out. Just go to Amazon. I think they have it the cheapest. So I'm an author and I am a trader. I'm not just here telling you about what might be good ideas. I put my money where my mouth is. I've been doing this for a long time. So I put my money where my mouth is. And I'm also the founder of the global leader in option trader education, which is Market Taker Mentoring. We have students in over 50 countries, and we've trained tens of thousands of students. I mean, at this point, in some capacity, literally hundreds of thousands, which includes our complimentary online trainings like this and in-person trainings. And I collaborate with a lot of the good players in the options industry here. I've been around a long time, so I know a lot of people, and exchanges sometimes ask me for help, and so do brokerage firms. And I work with the good brokerage firms who are options friendly, like Firstrade here. And I'm also a family man. those of you who are market taker mentoring students, you are already familiar with my wife, Kathleen, who runs operations for Market Taker Mentoring. I have my 2 adult children as well. And I do other things for fun besides trading. For one, I am a runner, which I enjoy. I enjoy doing it outside, more so than on a treadmill. And I'm a foodie, traveler, been all over the world together, either in, with my family for personal fun, and also all over the world with John Kamisik, who's my partner in crime here at Market Taker Mentoring. We've trained students in other countries. They fly us out there. And I'm also a music person. Now, if you want to check out my book, Trading Option Greeks, great. If you want to dig in, that's a great place to do it. If you just want to get a little bit more than what we talk about today, or just have a reference guide in your little hands, I don't think that's a bad idea either. Go to markettaker.com/QRG, because that's our quick reference guide, QRG, for the option Greeks. That's my gift to you. All right. So we're going to talk about the Greeks. Quick little review. Then we're going to go into outright trades, vertical spreads, and we could look at the Greeks of other trades that you find interesting as well. So a little review and beyond. So delta, there are 4 definitions of delta. Remember that? Delta is the rate of change of an option's value relative to a change in the underlying stock price. That is the textbook definition, and it's the best definition. Delta, and then the first one, that's what I call the textbook definition. The second one's the math nerd definition. Sorry for all of the math people out there, or the nerds out there. Although I would count myself in at least the latter group. The derivative of the graph of an option's value in relation to the stock price. Remember, calculus? Calculus. Yeah, but if you do remember calculus, that's basically all that is. That's all delta is. Delta is the equivalent of underlying shares represented by an option position. That is what I call the practical definition. Great way to think about delta and how it works. And I'm sure that will come up in some of our examples. And finally, the trader's definition, the estimate of the likelihood of an option expiring in the money, which is not necessarily 100% mathematically accurate. It is what I call the trader's definition. But I include it because, let's face it, every option trader I know uses that as a loose rule of thumb, as do I. So there you have it. Options that are in the money have a delta above 50. At the money have a delta of around 50. It's usually just slightly higher for calls, slightly lower for puts. And options that are out of the money have a delta of less than 50. The absolute value, if I add up the call delta and the put delta, and I don't look at the positive or negative signs, they will add up to just about 100 with a few caveats and nuances there. Time decay. As time passes, options lose their value. And for near the money options, I would say at the money options, but I don't want to, be like it's exactly at the money, but just close to the money. They lose their money at a faster rate as time passes, but in or out of the money options have a more linear rate of time decay. Time decay is measured by theta. That is the rate of change of an option's value given a change in the time to expiration. Now, when we look at theta in an option chain, it's typically based on a 7-day week, which, you might think, well, of course it's based on a 7-day week. Dan, you numbskull, there's 7 days in a week. Why wouldn't it be based on a 7-day week? Well, because there's 5 trading days in a week. So that actually has some important implications, mainly being that once we get to like Friday, by the end of the day, Friday, the market is typically taken out 3 full days of theta in one day because they have to take it out for not just Friday to Saturday, but Saturday to Sunday and Sunday to Monday. That is called taking the weekend out. When does the weekend come out? It comes out when the market collectively takes it out. All right. And then quick little review of this. And this one has to get reviewed because this is the trickiest one here of all of it. Volatility. What's volatility? Volatility is how much the underlying stock has moved around lately. That's realized volatility or historical volatility, meaning it's the volatility that has happened, that has been realized in the stock prices. How do we measure that? Well, we take the closing prices from the last month or so, find the standard deviation, and then annualize the standard deviation to make that last month representative of a full year. Then we can compare this expiration to that expiration, this stock's volatility to that stock's volatility, and realized volatility to implied volatility. What's implied volatility? You know what implied volatility is? It's the tricky one. Why is it tricky? Well, because it's kind of a concept that a lot of traders don't really think about. But you have to. The more experience you get with options, the more you will think about this. Implied volatility is, don't read it, don't read it. Implied volatility is this. It's how cheap or expensive an option is. You think about it that way, you're in good shape. Okay? Now, as far as what does that look like in, what does that mean? Well, we use the option pricing model, and that's one of the inputs into the pricing model, which we're going to look at in a second. Here, actually, let's just jump ahead here for a second. Basically, there's only 6 inputs into an options pricing model. Do you believe that? Like, I think I talked about this last week. Like, if I asked you, hey, what factors go into what an option is worth? If you're not familiar with what an option pricing model is and how they work, you'd probably give me 20 answers. Oh, there's earnings, there's stock patterns, there's this, there's that, PE ratio. No. All that gets lumped into stock price. There's reasons for what the stock price is, but the stock price relative to the strike price is one of the determinants of the options value. In addition to that, there's the interest rate, there's dividends, there's time, and then there was always this missing component, which the genius of Fisher, Black, and Myron Scholes was to consider it volatility, because they went with the assumption that people in the market would make decisions whether or not to buy or sell an option based on their estimate of future volatility of a stock. And there's something to that, isn't there? Like, if you're watching this live or shortly after I recorded this, which is like, today is March 25th of 2025. If you're watching this on recording, the market's been a little volatile lately, has it not? Yeah. So right now, people are much more inclined to buy puts to protect themselves. to buy, calls to play the market going up instead of risking buying a stock and, potentially losing big if it goes down. You're much more likely to buy options if you think the market's going to be volatile in the future. But if you think the market's going to be boring, well, then you would be more inclined to do things like, I'm going to sell some covered calls. Yeah, I'm just going to sell some covered calls. Or, yeah, I'm going to sell some cash secured puts. I'm going to sell some credit spreads. When you don't think the market's going to move a lot, you'd rather collect that option premium. So let's talk about this. Everything that I just said last, that implied volatility is interpreted as the market's estimation of the future volatility of a stock. It's a bunch of baloney. It's baloney. I mean, okay, it's kind of true, but those are the best lies, aren't they? The ones that kind of seem believable. There is no like panel of elders that gets together and says, well, what does the market say volatility should be? Slap the gavel down on the thing here. Okay, then volatility will be. That's not how it works. It works based on supply and demand. And I know right now, because I saw some new names, that statistically, some of you never looked at implied volatility. And that's okay. Going forward, you should. You learn, the more you earn when it comes to trading, right? So going forward, I hope you're going to be looking at it because I think it'll make you a much better trader. It's a degree of the supply and demand for options. There's the assumption, the original assumption from Black and Scholes, that people make decisions on whether to buy or sell options based on their estimates of future volatility. But do they all know? Not everybody does. A lot of newer traders to options don't. Some traders who subscribe to some newsletter service and the guy says, hey, buy these calls. It's going to be great. And you say, aye, Captain. And you buy the calls. That's how a lot of people start out. And then you move on to wanting more self-control, sustainability, and self-reliance, right? Start looking at things like volatility. So it's kind of a bunch of baloney. And so that is where you get your edge. When there's falsehoods and you can understand those falsehoods, that is how you can make money when other people can't, in my opinion. And I've been doing this for 30 years, so I know something. I'm not going to say I know everything because I don't, but I know something about something. Now, Vega. Vega is the rate of change of an option's value relative to a change in implied volatility. So when implied volatility goes up or down, meaning the supply and demand for options goes up or down, how much does it affect the options? That's measured by Vega. It's sort of like this translator, right? You've got this implied volatility that matters, but what really matters is the option price, right? So if implied volatility changes, let's just have a little mathematical translation into how much does that change the option prices. So it's measured in dollars and cents of option premiums. And puts and calls have similar Vegas to one another if they have the same strike and the same expiration on the same stock. Okay. Finally, as money is time and volatility change, the Greeks change. As options get more in or out of the money, delta changes because of gamma. We remember that, right? At the money gamma, Vega, and Theta is higher than in the money or out of the money, gamma, Vega, or Theta. As time passes, in or out of the money option deltas move away from 50, meaning in the monies move closer to 100, out of the monies move closer to zero. At the money, Vegas get smaller. At the money, thetas and gammas get bigger. Volatility, an increase in volatility will cause the deltas of all options to move towards 50 because it's greater uncertainty, right? 50-50 is the most uncertain thing there is. And a decrease will cause all deltas to tend away from 50. An increase in volatility will cause Vega and Theta to increase and gamma to decrease. And as the interest rate rises at the money, call deltas get bigger, put deltas get smaller, and vice versa. Okay. All that was review, man. Right? All that was review. So you should know that already. If you don't know that, guess what? I've got great news for you. The good people at Firstrade, you know what they do? They don't only provide you with free education so that you can be a much more informed trader when you trade on their platform. First of all, you should send them a big thank you. You should go and hit the questions box right now and send them a big thank you. I would do that. I don't work for Firstrade. I'm a third party that comes in here to do these presentations. I'm not a Firstrade employee. So that's why I say you should thank them. This is pretty great, right? Giving you free education. But not only do they give you this free education, they record it as well. And they put it on their YouTube channel. And so if you ever miss one, guess what? You get to go back and see the ones you missed. Or if you're like, oh, what did Passarelli say about that Vega thing that one day? You get to go back and review it. So there's a lot of great stuff here. Now, here's what I really want to get across today. The Greeks, delta, gamma, theta, Vega, they all move independently of each other. So we need to monitor each one individually because delta is going to move. It's going to change based on all the things we just said. Gamma is going to change. Theta is going to change. Vega is going to change. So we need to monitor each one because they're all going to change and we need to look at them in concert together, right? We hear the saxophones, we hear the tubas, we hear the timpani, the contrabass, violins, cellos, I don't know what else. Glockenspiel. We hear all these things, but together we hear the concert. So let's see what this looks like in a really, really simple example, okay? Let's say we're bullish. Hey. Let's look at a real example, should we? What do you think? I think it's really useful to know how to do this in the Firstrade platform. I'm going to skip this PowerPoint. Let's just throw this darn thing away. Does anybody have a stock or an ETF that you're bullish on that we can use for a hypothetical example? Throw that in the questions box. Let's take a look. All right, just throw the stock symbol in the questions box. Okay, hey, we got somebody already here. We got one. We got two. Okay, folks. Okay. Lisa, you were first. So FNMA. Whoops. What the hell? Where'd that go? Hold on a second here. FNMA. Let's take a look at this here, okay? Hold on a second here. Yeah. Let's just take a look here. Okay, so FNMA. Gosh. Oh, that's Fox News, right? FNMA. No, Federal National. Oh, Fannie Mae. Duh. Thanks, Lisa. Hey, Lisa, you're new. Yay. Welcome. Come every week, will you please? All right. So, Fannie Mae. Let's take a look at Fannie Mae. Lisa wants to take a look at Fannie Mae. Let's take a look at Fannie Mae. So, the first thing we're going to do here is we're going to go to stocks ETFs. Oh, shoot. We're going to go to real-time chart. And we're going to go to, oops. Oh, hey, wait, hold on a second here. FNMA. So look at Fannie Mae. What's your rationale for Fannie Mae, Lisa? I bet it has something to do with quantitative tightening. I'm just going out on a limb here. Fannie Mae's not one I look at all the time, but so we have Fannie Mae, and it's doing what a friend of mine calls a rest and run sort of thing, right? It's boring, bumping along sideways, and then ding, right up, and then boring, bumping along sideways, then bing, right up, then boring, bumping along sideways, then bing, and then back down, and then back up. The highest is 8. Let's see. Is the highest? Let's see. Let's go back 5 years. Ooh. Let's go back 10 years. Ooh. Wow. This sucker's on fire. Can we go back even farther? Let's see. Ooh, we can. What happens if we go back? Oh, yeah. See, that's what I thought. Interesting, right? Federal National Mortgage Association. That's the one that got just annihilated during the financial crisis of 2008, right? So making a bit of a comeback here. Here, let's get this back to 1 year. So by no means is one to assume that this is just like, you know, we're at a top here that we can't ever get past. So, okay, Lisa is bullish. Lisa is bullish. Been a conservatorship. Yeah, exactly. Right. Okay, so how would we play this? You know? Well, I mean, here's what we need to do. We want to look at options. Oops, that's not the right one. This is the right one. We want to look at options. FNMA. And we need to look at the option chain, right? Because that's what we do here. Go. What's happening here? FNMA. Oh, maybe, you know what? There are a couple of symbols that we can't pull up. Oh, geez. Ah, you know what? I'm really sorry about this, Lisa, but that is one that we aren't able to pull up. I'm sorry. It's just stocks, equities. But the idea is, here's the idea. You would look at the delta, you would look at the theta, and you would say, how long is my time horizon? And how long is your time horizon on Fannie Mae, Lisa? Let's go back to the chart here. How long is your time horizon? Oops. About a month or more. So if it's a month or more, you know, you've got 30 days of theta coming out. So you would have to look at, obviously, what is the delta? um, you'd have to look at what is the delta, and you'd have to look at what is the theta, because you know that it's going to lose money over time. And so if it's 30 days, I wouldn't buy a 30-day option. If it's 30 days, I would buy more like a 60-day option so that all the time decay doesn't disappear and that the theta is lower, because longer term options have a lower theta. So I lose less as time passes. Pretty good stuff there, right? Cassandra, we're not going to get into the options wizard today, just because to me, oh, Fannie Mae doesn't trade options. Okay. Yeah, it's like I said, it's not one that I haven't looked at Fannie Mae in probably since 2010 or something like that. So yeah, I'm not going to use the options wizard because I really want to empower you to understand how this stuff works. And if you end up using the options wizard, you'll just be able to use it better because you're not just saying, oh, well, this random thing says this is a credit spread. Um, you'll be able to say, okay, this is a credit spread, but is it good? Let's look at the delta. Let's look at the theta. Okay. So anyway, let's move on to coin right now. That'll be a good one to look at. COIN. Real-time charts. So this is 6 months. Let's go to a year. Okay, so this is a year. Let's look at daily candles though for a year. Gonna have to just gonna have to go down here and spread it out a little bit. So interesting, right? Coin's an interesting one for a couple of reasons. One, because it has a lot to do with crypto, but it is not in and of itself crypto. It is a company that enables you to trade crypto. So it's not just if crypto prices are up, coin is up. That's part of it. Because when things go up, it makes people more interested in it. Like, you want to hear a funny story? So my company is Market Taker Mentoring, right? We train options traders. With options, if the market goes up, you can make money. If it goes down, you can make money. If it's boring, goes sideways, you can make money. If it's crazy volatile, you can make money. But weirdly, when the market is going up, people get more interested in wanting to do classes with us. To me, that doesn't make any sense. For me, like right now is when I would be signing up for options classes. Like this is one of the best option trading markets I can remember in my life. But, sometimes people who start from an investor standpoint, like, oh, I buy and hold stocks. When the market's up, that's good. Like your brain doesn't realize, oh, there's all these other opportunities. Like this is literally one of the best times to trade options. This is my opinion, right? This is my opinion. One of the best times to trade options that I can ever remember in my life. Right now is when everybody, and you know what? We've got a few more people in here than we usually do. So I guess maybe you guys are the smart ones. Anyway, it kind of works that way with coin. When crypto's going higher, it tends to go higher, but crypto's kind of been going higher, right? And so why is it down so much like this? Well, I don't know. It must be, it has to do with their earnings and how they're running the company and such. So, are you also bullish on coin, Lisa, then? We definitely established some support at $177.50. Okay, at least he's bullish on coin. So for me, if I'm going to think about doing something like buying a call or taking any sort of bullish position, I love to see some support that we bounced off recently. And this is pretty solid support. Not only did we bounce off it a couple of times here, we bounced off it here. It was like resistance here, it was support here. I mean, this is a key level. So, sure, you know, I'm not advocating this or anything like that. It's just an example as far as I'm concerned. But you can easily justify this for sure. So let's look at how we might trade this. This is how Greeks really come into play. So we're going to go to trading. We're going to go to options. We're going to go COIN. We're going to go get option chain. Now, is your time horizon on this also about a month or so, Lisa? Because we've got 3.5 more days. Oh, you just like to swipe whatever you can? Okay. Well, so with stock as a long-term investment, swipe whatever you can. Goes down, average price, fine. That is a reasonable strategy in a lot of cases. When it comes to options, we need to tighten up some parameters. We need to, damn, Lisa, made 19K a few weeks ago with this one. I like what I'm seeing here. That's great. All right. So with options, we can't just say, oh, I'll buy some. And when it goes up, I'll sell some. We have to, because they expire at some point, and because as each day passes, I'm working on it, Lisa. I'm working on it. As each day passes, it loses a little bit of theta, right? And so that's important. We have to take that into account and consider that. So let's say my time horizon is a month. Well, that would put me to about a target of April 25th. Well, if I buy some, let's say I think it's going to go up to 210 or 212 and a half. If I think it's going to go up to 212 and a half and I buy the and I'm right, or you think it's going to go up to 240? Okay, so if I bought the April 25th 240 calls at 340 and it goes up to 240 by April 25th, guess how much I make? Zero. I lose. So I really need to think this through and think, well, what strike am I going to buy? What expiration am I going to buy? And because I know that the more time I buy, the lower my theta, I want to buy more time. So I might consider buying like the May 16th expiration. So let's look at that. In fact, let's compare the April. Well, and if my target's 240, I'm not going to buy the 240s. I'm going to buy something lower than 240 so that if it gets to 240, I will have made money. Right now it's at 200. So maybe like, 220 calls or something like that. So let's look at the thetas and deltas of the April and May options. So we got to go to Greeks and analytical, and then we got to repopulate the April and the May. And then we got to go to Well, I'm not able to get to the 2 4. Let's just say, yeah. Oh, yeah. No. I said buy the 220s or 230s. So let's say we buy the 220s. So the 220s in April have a 34 delta. The 220s in May have about a 42 delta. So it's actually a bigger delta. Okay. What about theta? Well, the 220s in April have a 21.5 cent a day losing theta. The theta in May, it's only about 20 cents. It's a little less. Can we do even better? What if I buy the June? Well, if I buy the June 220 calls, oh, now my theta is only 15 cents. And my delta is still, well, my delta is even bigger. It's 46.5. So I would be much better off buying the June 220 puts, or calls rather, because I have a bigger delta and a smaller theta. I want to make money on my delta, so I want it to be big. And I know I'm going to lose money on theta, so I want theta to be as small as possible. So this is if I'm just old fashioned, not even old fashioned, but just buying a call, right? But I could take this even farther. I know what I could do is I could buy these 220 calls with 42 delta and sell the 250 calls, give it room to run all the way up to 250. So I get a 42 delta long and a 23 delta short. So I give up half my delta. I'm only long about 19 deltas, but I only lose 4 cents a day in thetas. I give up half my deltas and I give up 75% of my losing theta. My delta theta relationship just got a lot better, didn't it? Right? And, that's in the May. If I did the June like that, my delta, it would be 16. So a little bit more than it was in the May. Because 46 minus 31. So I guess, yeah, 15. My theta would be 15 cents minus 13 cents. Oh, theta is only 2 cents. My delta theta gets even better if I go to June. Yeah. But the thing is, in order to reap my maximum profit, when it comes to debit spreads, like, the time, there's not just a price target, which is the strike you're selling, but there's a time target. Because if I do the June and it goes up to 250 by the end of April, well, I'm still going to have to sit there and wait for it to reach its maximum profit. Oh, trouble seeing the numbers? Yeah. Well, it doesn't. I mean, I'm telling you the numbers. I mean, the exact numbers really don't matter that much, I don't think. Here, maybe I can make it. Hold on a second. There you go. How's that? Yeah, that's pretty good, right? Yeah. All right. All right. I like the enthusiasm with the all caps over here. It's like, yeah, man, that's better. Okay. So, good. Good. So, you kind of have two choices there. You can just go ahead and buy the call if you're bullish. You can buy the call spread if you're bullish. But just remember, with the call spread, it really is timing. If you just go up right to the short strike, you're not going to make your maximum profit until you're close to that expiration date. You are welcome, Lisa. Now, Manuel. What am I saying, Manuel. Sorry about that. Says, let's take a little look-see-poo at Tesla. So here, let me for the chart, we'll make this a little bit back to normal size here. And we'll go to stocks and ETFs. We'll go to TSLA. We'll go to real-time chart. And we want to make sure that we set this. Oh, so this is daily candles. Stretch this out to about a year. Why not? Wow, Tesla had a little bouncy bounce here. Oh my God. This is kind of almost like a similar thing here, isn't it? Like we've got great support right here at about 217.5, this area. Support here. I mean, wow, yeah, we've got really good support here. Holy cow. So we got this nice little bouncy bounce. And so Manuel is bullish. Let's take a look at how Manuel might consider trading this. We go to options, TSLA, Tesla. Well, hey, hold on a second. Let's go back. Let's add a little bit of new knowledge to this. Hold on a second. Stocks ETFs, real-time chart, TSLA. Real-time chart. So, Manuel, when it comes to options, we have to set a price target and a time target if we're going to do this right. Let's look at it. Oh, hold on a second here. Now we're too big. What is your price target and time target? What is your price target and your time target? I see you're talking about leaps. Long-term perspective of 2 years. Okay. So you gave me your time target. Excellent. I like the way you're thinking, man. What is your price target? Where will Tesla be in 2 years? 2000. Oh, wow. You're bullish, baby. You're bullish. Okay. So when you're looking for a really explosive move like that, we don't want to limit it by doing a bull call spread. Because whatever strike you sell, because a bull call spread, you're buying a call and you want to make money on the delta of it, but you're going to lose money on the theta of it. So you sell a call and that brings in theta to offset the theta you're paying. But if it gets up over that strike that you sell, you're giving up upside potential. And to be honest here, we're not going to be able to sell the 2000 strike. I don't think. We can take a look, but let me shrink this back down. There we go. So, okay, let's take a little look-see poo here. We're going to go to trading. We're going to go to options. We're going to go to Tesla. We're going to get the option chain. We're going to look at, go. We're going to look at, calls and puts. We're going to look at leaps only. We're going to look at out of the, and we're going to hit go. What's the highest strike? There's only one leaps listed. 2 years. Okay, so that's 2 years. The highest strike I see here is 960. So if you're looking for it to go to 2000, you don't want to cap your gains above 960, do you? But if they're only 18 bucks, I mean, if we go another $1,000 higher, you're not going to be selling the 2000 calls for any. So we're probably just going to want to buy calls. Now you look at this and say, geez, Louise, is at the money calls, they're like $100. Well, that's still just about 35% of what it costs to buy the stock. You're still risking so much less. But it's got to be over 380 at expiration to break even. But that's the nature of options, right? And if it gets there faster, we pay less in time decay. So we'd probably want to buy something of a little higher strike, especially if you're looking for that big of a move. I mean, you can save a third of the cost by just going to the 400 strike. You're just giving up $100 off your $1,720 projected move. I would buy the 400s for sure. Heck, maybe even the 500s. There you're saving 50%. But let's take a look. I know we're not going to be able to see like the full range of Greeks here, but we'll be able to see some of it. Oh, I've got to change or oh, there we go. Yeah, so well, we can see up to the 320s, but that's fine. Right? Yeah. So the theta, I mean, look at the theta on a $320. It's only 7 cents a day, and that's the 320 calls. We go up to the 400 or 500 calls, it's going to be even less. It's probably going to be 6 cents, could even be 5 cents for the 500 calls. My delta for the 320 calls is 67. We get up to the 400 or 500 strike, it's going to be smaller, but what's going to make the delta bigger? Hey, let's see who's been paying attention. I know this is some of your first times here, and maybe you missed the rest of Greeks month here. You missed the rest of Greeks month, but if this stock, if Tesla goes up, my call delta is going to get bigger. Why is my call delta going to get bigger? Why is my call delta going to get bigger? Who can tell me that? Anybody? Who can tell me why is my call delta going to be bigger? Oh, we got answers. We got answers. Oops. Where are the answers? Oh, a second. I got to pull this back up. Justin, yes, but I'm looking for a one-word answer, and I'm going to give you a hint. It's a Greek. It's a second order Greek. Not Vega, Cheryl. Good guess, though. Hey, Justin. Hey. Perfecto. Good job. Gamma. It's going to get bigger because of gamma. Great answer. Great answer. Okay. So let's see here. Just deleting some of the stuff here. Everybody else's answers were actually right, but I was just looking for it phrased in as gamma. So like, gosh, man, the theta is so small. Now, as time passes, if Tesla stays here, gamma's going to get big, or theta's going to get bigger, right? But if Manuel is right, and let's say 6 months from now it's trading at 700, well, now these are going to be in the money quite a bit, and the theta is not going to get as big because in the money thetas don't change as fast as out of the money thetas. You guys are asking great questions. Nitsu says, or how about buying this leap and sell the leap when it goes up by 20% or more? Yeah, yeah, yeah. I love that too. I mean, it depends on your price target. Like if the stock goes up 20%, that's one thing. If the leaps goes up 20% in value, that's another thing. But, right now it's at, just call it 300. 20% is just $60. That's like 360. If you're looking for it to go to 2000, you might be selling yourself a little short if you get out that early. So you have to, you really have to set a price target and stick with it. And you don't have to get out of the whole thing all at once either. You can get out of half now and half later, or a third now and a third later. Okay, one more. We can't let Cassandra hang here. We need to help Cassandra here. Stocks, MSTR. Okay. So this is MicroStrategy. Gosh, don't all these charts look the same? Like the whole market's doing the same darn thing. Bouncing off support. Oh, this is really funny, Cassandra. You want to know something? I built this just popped up. This is crazy. This just popped up like a few minutes ago. I built a scanner for when traders like when professional traders make a really big credit spread trade, it pops up on my scanner. I like worked with the CBOE for months. The data comes directly from the Chicago Board Options Exchange. Check this out. This just happened 7 minutes ago. Somebody sold the 340 puts and bought the 320 puts in MicroStrategy that expire on the 28th. That means as long as it stays above 340 by Friday, this person makes money. They're trying to make $6.50, risking $13.50. And that's another way to trade it. It won't. So that's another way to trade it. Put credit spread. And let's look at that. Okay, let's look at this as a put credit spread. I'm sure you could buy calls, but let's look at it as put credit spread. Okay, so we're going to go trading. We're going to go to options. We're going to go to MSTR. And we're going to go to option chain. And we're going to go to calls and puts first. We're going to go to all and bingo. So this would be the March 28th expiration. So this person sold the 340 puts. Wait a second now. March 28th. MSTR. Oh, yeah. No, I got it right. Sold the 340 puts and bought the 330 puts. Collected $6.50. So the one thing we know about credit spreads is if it stays above the short strike, so above 340, and you just leave it on until expiration, it represents the maximum profit. Like whatever you sell it for, you get to keep and it expires. But, I like to look at it a little bit deeper. So let's go to the Greeks. My delta is going to be 15. So a little bit of move higher, it's great. It helps. Now, I know that the out of the money puts are going to move towards zero. And the at the money puts, they're going to stay close to 50. So my delta is going to get bigger as time passes. I also know that on these that I'm selling, I'm making $1.42 a day and I'm paying $1.32 a day. I'm making 10 cents a day. But I know that the at the money puts are going to get their theta is going to get bigger as time passes. I'm going to make more a day. That was a pretty aggressive trade. Personally, when I make credit spread trades, I like to sell a little further out of the money. But a lot of professional traders actually trade credit spreads where they're selling close to the money. So that's the way that I would analyze a trade like this, by the way. Now, all that being said, friends, guess what? We're out of time. So I hope that you'll do a couple of things. I hope that you will first grab my ebook or a quick reference guide, I should say, markettaker.com/QRG, markettaker.com/QRG. And I'm going to put that in the chat. So markettaker.com/QRG. So I think you should be able to see that and just click on it because that's my gift to you. And if you are the kind of person who listens to podcasts, please check out my new podcast, which is Wealth Building with Options. Wealth Building with Options on Apple Podcasts, Spotify, whatever you listen to your podcasts on. And that said, friends, have a great rest of your day and trade smart. We'll catch you next time.